Fact or fiction, bonds are for the elderly. Welcome back to The Motivated Investor. Today we're diving into a topic that sparks a lot of debate in the investment community. Are bonds really just for the elderly? Many people hold the belief that bonds are a safe haven for retirees, while stocks are reserved for the younger crowd chasing growth. But is this notion grounded in fact, or is it merely fiction? Let's break it down. To start, let's clarify what bonds are. Bonds are essentially loans made by investors to borrowers, typically governments or corporations. When you buy a bond, you are lending your money in exchange for regular interest payments and the return of your principal at maturity. Sounds safe, right? This safety net is one reason why bonds have become synonymous with conservative investing, often associated with older individuals looking to preserve their wealth. However, labeling bonds as elderly investments overlooks their broader appeal and functionality. Bonds can play a vital role in a diversified investment portfolio, regardless of age. They offer stability and income, which can be beneficial for younger investors too. In fact, many financial advisors recommend including bonds in your portfolio early on to help balance the risks associated with stocks. Now, let's consider risk. Young investors often lean towards stocks because they are perceived to offer higher returns over the long run. While it's true that stocks can be volatile, bonds can provide a buffer during turbulent market conditions. When stock prices drop, bonds often hold their value or even increase, making them a smart choice for those looking to mitigate risk. Moreover, bonds come in various types, catering to different investment goals and risk tolerances. For example, corporate bonds might offer higher yields but come with increased risk, while government bonds are generally considered safer. This versatility means that investors of any age can find a bond that fits their investment strategy. Additionally, let's talk about interest rates. When interest rates rise, the value of existing bonds tends to fall. This phenomenon can deter some younger investors who may view bonds as less attractive. However, understanding interest rate cycles can help young investors capitalize on bond investments when rates are favorable. Timing and strategy are key, and savvy investors of any age can benefit from a well-planned bond investment. Another misconception is that bonds lack growth potential. While it's true that bonds typically provide lower returns than stocks over the long term, they can still be a valuable component of a growth-focused portfolio. For younger investors, reinvesting bond interest can lead to significant growth over time, particularly in a rising interest rate environment. So is the idea that bonds are only for the elderly fact or fiction? It's clearly fiction. Bonds are not just a refuge for retirees, they are a fundamental part of a balanced investment strategy for individuals of all ages. Whether you're looking to preserve capital, generate income, or mitigate risk, bonds can play a crucial role in your financial journey. In conclusion, don't fall into the trap of thinking that bonds are only for the elderly. Embrace the potential they offer, no matter your age or investment stage. Thank you for watching this episode of The Motivated Investor. If you found this information helpful, please give us a thumbs up and consider subscribing for more insights into smart investing. Until next time, keep learning and stay motivated.